concerned we're heading into another 2008 in the real estate industry? Stay tuned. I'm going to talk about exactly that. Okay, so the big question has been here lately, are we running into another crash? Is this 2008 all over again? A lot of people think so, and they are carrying a lot of fear. So let's kind of talk about the differences between now and 2008, and hopefully you'll be able to conclude, come up with your own conclusions on where this thing's going to head, where this market's going to go. First of all, anybody that tells you they know exactly where the market's going to go, they're just kidding you. No one does. However, we analyze this thing pretty closely just about every day. We listen to a lot of experts, and I'm going to go ahead and talk about the differences between 2008 and where we're at currently. So one of the first things that you're going to want to take a look at is let's talk about the market as a whole. See how we're doing year to date, okay? Let's compare 2022 to 2021. Now I'm talking to you right now. It's the end of July. We're just about ready to wrap up the month. So these are pretty active numbers. So as a whole, in the state of Georgia, let's just talk about Georgia itself. We have seen an 8% increase in the number of listings that are actually on the market. So we've talked about the depletion of inventory and so on and so forth. Well, we're starting to get a lot more inventory that's building up in the market. That's actually a good thing. That's a healthy thing. We'll talk about that here in a second. Pending sales, those are homes that were on the market and they went under contract, has decreased 17%. That's pretty significant. Not many buyers are out there buying houses. That's what that tells us. Closed sales is actually down 13% year to date. That's another indication that the market is slowing down. There's not as many transactions that are occurring. And inventory levels, again, have increased 24% as a whole since the beginning of the year. When we look at last year's inventory levels compared to this year's inventories, we're actually up 24%. So those are kind of the high level indicators that we take a look at of how we're doing this year compared to last year. Now last year, you got to remember, it was a crazy year. We broke all kinds of records. So take that as a grain of salt. So now let's dive into the differences between 2008 and where we're at currently. Now, hey, listen, if you went through 2008, there was a lot of people that got hurt during that whole scenario. I lived through it. It was painful. So I got a little PTSD when it comes to what's going on in the market. And I always have to check myself. So give yourself a little grace there. If you're kind of that situation and you're really holding on to a lot of fear, it's totally understandable. So here we are. Let me explain to you what the differences are. Let's talk about inventory. Everybody's talking about the differences between inventory. Now, in a balanced market, there should be 6 months of inventory on the market. That's the standing inventory, about 6 months worth. In 2008, when we hit the crash, we had 15 months of inventory, standing inventory on the market. We had more inventory than we knew what to do with. We had more inventory than we did buyers. Today, we have just over 2 months of inventory. And for the last 2 years, up to about a month ago, we were under a month. So extremely depleted in inventory. So that is a huge indicator that says that we're much healthier now than we were in 2008, just because of the lack of inventory, right? And because of that lack of inventory, there's always going to be pressure on the existing houses that we have, upward pressure on prices. So from that indication, inventory levels are short. So that's a good thing from where we're at compared to where we were at in 2008. All right, the other significant thing is financing. Let's talk about the money that was being supplied in 2008 compared to what it is now. Hey, I got to admit, in 2008, I've heard the analogy and it's perfect. It's kind of like the teenagers were home and the parents threw the keys to the teenagers and left for the weekend. It was crazy, right? All kinds of crazy different lending out there. You didn't even have to verify your income. They were handing money out like it was candy. And because of that, we had a lot of really dangerous supporting financing in the real estate industry in 2008. After the crash, once some of those high risk loans started defaulting, it was just like a domino effect and it just took the whole industry down. And that's really more or less basically what happened in 2008. Today, we are in a much healthier and different scenario. Some of those high risk loans, the parents basically came home, is what happened. The parents came back, they took the keys from the kids, and they said, enough, we're not going to do this anymore. And they grounded everybody and sent them to their bedrooms. So that's kind of where we're at right now. The financing is much healthier now than it ever was. Those no verification of income loans, they're gone. The high risk loans that started you out at a really low payment, and then a year or two later, they would mature and your payments would like double or even triple. Those are gone. So from a financing standpoint, the real estate industry is much healthier than it was in 2008. All right, let's talk about home equity compared to what it was in 2008. Back in 2008, it was very common for people to actually maximize and pull out all the money that they had built up in their homes and take it in cash. So they were refinancing out people's equity, the amount that their house was worth compared to what they owed on it was just about even. People were maxed out. They used it as a piggy bank. Their house is a piggy bank. They were just really maxed out. Today, because we have seen value increases climb so quickly over the last couple years, people have more equity built up in their homes right now than they ever have in the past. So that's a really good thing when times get tough. If a situation occurs where someone has to sell their home, now, today they can actually afford to put it on the market, pay an agent to do so, and sell the house and still have cash left over in their bank. In 2008, that was not the case. By the time they went through all the expenses of hiring an agent and selling it, they were upside down, and that's why they couldn't sell it. They had no equity. They had no room to move. So what happened is they basically had two choices. You file bankruptcy or you lose it in foreclosure. So 2008 compared to now, homeowners are in a much healthier position than they were 2008 as far as the equity that they have in their properties. It gives them all kinds of different options if they do find themselves in a situation where they have to sell. All right, the other difference is loan modifications. Back in 2008, there was virtually no loan modifications. So if you did get in a situation where you got into trouble in 2008, couldn't make your payments for a while for whatever reason, you'd go back to the bank and they didn't have a lot of options for you. They were like, catch up your payments or sell the house or file foreclosure. So, those three scenarios happened. There was no loan workouts. None of those really existed until the crisis really was in full force and the federal government stepped in and forced the banks to work on some kind of loan modification programs. That was years after 2008. The crisis was well underway. They did eventually come up with some loan modification. If you guys remember the HARP loans that you could get, those started percolating up. But once again, most all the damage had already been done by the time those modifications were invented and put into place. Today, because of all the changes in the laws and the groundwork that we have done in the financial world, those modifications are somewhat commonplace. A great example of government and business working together was during COVID. You may have your own opinion of this, but the government stepped in and worked really well with businesses in getting those loan modifications available to all the consumers. And a lot of people have taken advantage of those over the last couple of years. All that groundwork was already set in place. The programs were already set in place. It was just kind of a plug and play. So even with the COVID shutdown, a lot of forbearance folks, people are saying, all those homes that people haven't been paying on, they're all going to foreclose. They're really not. They're getting modified at a huge rate. A lot of those folks are just jumping right into a loan modification programs. The banks have had years to get to understand how they work and implement them. So they work very smoothly. There's not this big cumbersome bureaucracy that you have to go through anymore, which was the case back in 2008. So anyways, loan modifications are there. It's a great option for folks to keep them in their homes and keep from having all this slew of foreclosures that are actually hitting. An interesting stat about foreclosures, just to kind of give you an idea, as a whole, historically, it is very typical for about 1% of all the mortgages out there to go into foreclosure. That's kind of the benchmark. As long as we're at that 1%, that's pretty typical, and no alarms are being alerted. Back in 2008 and into 2009, that percentage creeped up to 15%. So 15% of the homes that had mortgages on them were going into foreclosure. To give you a perspective of where we're at today, we're at 0.6%. So hopefully that kind of gives you a little comfort that we are not looking at any kind of a foreclosure crisis anytime soon. All right, still concerned? Still think there's going to be this big crash going on? Just keep in mind, inventory is low. When inventory is low and demand is still relatively high, yes, it has shrunk, but it's still pretty high. It's going to elevate those prices. It's going to keep and maintain those prices. Now, I'm not saying that we're going to continue to see the increases in values that we've seen over the last couple of years. It is very likely those are going to plateau, maybe even be flat, and it may even go down 1 or 2%. I don't know. No one really knows, but those are probably more realistic expectations than an absolute crash or a continuation of where we've been over the last couple of years. The demand is also really important to understand. Listen, real estate is local. It's one thing to listen to the national news and national averages and listen to the national news about real estate. You've got to get down to the local. You got to talk to your real estate agents like ourselves that understand what's going on in our counties, in our cities, and even down to the neighborhoods. So right here locally in Cherokee County, Cobb County, in the North Atlanta area, we always just call North Metro Atlanta, lots of demand. We've got migration, we've got people moving in here. Our employment is really good. People's incomes are rising. We're keeping above pace of what the national average is for incomes. So as long as all of those things are in place and they stay continued, there's still going to be a lot of demand for housing, and we don't have enough. So that is going to continue to elevate and put upward pressure on prices. So that's your supply and demand. All right, so interest rates have kind of taken it in the chin, right? They have risen. So that's the one area that we've got to really take a look at. That in itself has really been the cause of a lot of the decrease in the demand that we have seen. It's just, it's more expensive to buy a house. The buying power isn't as great. You've priced out a lot of people. The first-time home buyers are really struggling right now because they just have been priced out with the increase in rates. We're going to continue to watch and see where rates go. No one really knows what they're at. The best projections that we have seen so far is they might go up a little bit more than where they're at right now by the time we get to the end of the year. A lot of people are predicting that they're actually going to come down a little bit. So who knows where they're going to be, but we're going to continue to watch and see where the rates are. But yes, absolutely, rates are the one area indicator that we look at that has really taken it on the chin lately. I certainly hope that kind of gives you an idea of where we're at today. Once again, no one knows exactly where we're going to be heading. However, based off of all the information that we see, this is not a repeat of 2008. So please do not get yourself all in fear. We see a continued healthy real estate market moving forward, not only through this year, but even into next year. So I don't see the crazy value increases that we've seen over the last couple of years. It's probably going to plateau. It's going to level off, and it may even come down a little bit. And hey, it's a good thing. It's a healthy thing. If you've been out there as a buyer in the last couple of years trying to find yourself a home, it's been tough. It's been a struggle. And so that's going to start loosening up a little bit, and we're going to get back to more of a balanced market that we're all used to. So this is a good thing overall. I sure hope this was helpful and gave you some insight of what's going on in our local market. And listen, don't be fearful. This is all good. It's healthy. We got a great area that we live in right here in the North Atlanta market. We are so fortunate for everything that we have here. People are flooding here. They love living here, and it's just a wonderful place to grow up, raise your family, and I couldn't be happier where we're at. So you should be too. If you have any other questions, want to reach out to me, ask any questions about specific neighborhoods, be more than happy to share all that information with you. Hope everybody's having a great day and talk to you soon. Thanks.